Welcome to a special happy hour edition of Power Down. Nice shades. Are those the shades of a Forbes contributor?
Hater blockers.
Maybe, yeah. The shades.
Shades. Also, let's say Jonathan should introduce himself to our audience.
I agree.
I'm just some guy. No. So Jonathan Crowder, I'm Kevin's partner at Intellis Capital. So, I've worked with these two clowns off and on since, 2014, something like that. We all still talk. So, that's encouraging signs. It just says bad things about your taste, but what can you do?
That's right. We talk and we text a lot. Probably too much.
Kevin's and my wives would say we text too much.
Yeah.
How many a day do you think go between you guys?
Oh,
100?
Oh, well over.
I mean,
but are we counting Slack?
Oh, geez. Yeah.
Everything. How many messages?
Oh, it's 500. I mean, it's pretty much every hour of at least a few.
Yeah.
From 8:30, 9 a.m. to 10:30, 11 at night, maybe midnight sometimes. Yeah. Depending on the day. Yeah.
It's a lot, you guys.
You are not mistaken.
This is a non-standard number.
I mean,
yeah. The other day, Kevin said via text, of course, he said, I know who you work married, and I said, and I'd say I do all over again.
Right.
Yes. Good. How cute.
Yeah. So,
I'll be your pastor.
What was it? When we were at Shoes, we worked out, and John at one point said we were having a conversation. And John goes, "This is the most bro conversation I've ever heard in my life." We've grown up since then, but
we have.
I forgot you guys would go to the work gym every lunch hour.
Yeah.
Forgot that.
But so tell us a little bit about the Forbes. I'm actually curious because we had never, as much as we do talk, we'd never talked about the premise behind that article. Where did you come up with that idea?
Okay, so for reference, this was the royal wedding of energy between Tesla and NextEra. And I first got, I was pinged by Amy Feldman at Forbes. She runs the manufacturing and industry section of Forbes because she saw that I had posted an article about Uber. When Uber announced they were going green, I made a comparison, just for everybody's reference, this is like 1,600 wind turbines or something, equivalent of energy being converted to renewables versus fuel. And like the tangible nature of that, most people just can't have a hard time relaying what a fuel tank looks like in renewable energy. So she liked that combination and got tapped to try a few of these. And so the first one I wanted to have a little fun with, which was Tesla has done a great job knocking down barriers in the automotive industry. That looks like they've won that space, although competition will come. And what's next? And the fact is that they can do a really good job of bringing cars from fuel to electrons, but the tailpipe issue, the long tailpipe issue, as we call it, which is a coal or natural gas plant, is still powering that electron through the power grid. So who should they go after? And that was the idea. Just fun. And NextEra is the number one utility in the US. They're the most progressive on electrification, decarbonization, et cetera. And I know there's very big fan bases independent for each of those firms, which I tapped into, maybe incorrectly. Because most of the Tesla people said we should never go into the utility space, and the utility people said, don't bring that culture over here. But I feel like all the reasons that people didn't like it were cultural, which means it should probably happen. Because that's how we break stuff down. Yeah, I know. What do you guys think?
I actually agree with the culture part. That's how you break walls down. We've talked about this a lot with podcast guests. We've talked about this on Power Down some, or on Electrified some with the guests. There's a balance between expertise and naivete and new entrants. And if you can get them both, that's a powerful combination. And so does NextEra probably need a little shaking up, even though they're the most forward-thinking utility? Probably so. And I don't know, Tesla could probably use some of the culture and systems put in place by a big utility, would be my assumption.
You know, actually, I was going to turn it around a little bit. I was going to say, John, you just dug into NextEra a little bit. Why do you think NextEra has been so successful versus like another group that's tried kind of a similar playbook, which was, I think, like NRG kind of tried something similar, focused on renewables. Famously, this cost David Crane his job. Why did NextEra succeed when others have struggled so much there?
All right, so there's the regulated side of the business, and then there's the deregulated for the folks listening, for the 5 of you. The regulated side means that they can pass the costs on to their rate base for the supply and the transmission. The deregulated is just the transmission. Renewables, the installation of utility scale renewables is saying your transmission cost will be the exact same, but your supply cost is going to be a fraction. Because we are taking, if it costs $100 to run a coal plant, like $60 of that is the value of the fuel going into the coal plant these days. So what they're saying is, we'll retire that coal plant and we'll still charge you $40, the remaining $40 for another 20 years, by the way. But we're going to replace the fuel cost with renewable cost. And utilities can depreciate the installation of that utility scale project. And so what David Crane didn't get right was that he was installing in a deregulated market where he couldn't pass along a lot of the cost to the customer. That's it. NextEra has done an incredible job at finding a way to pass along renewable installation costs to their customer base.
So it affects their discount rate, and thus the whole economic model looks different.
Yeah. And they're getting paid to install. What is important for the Tesla situation is that game only lasts so long. When there's no more coal plants to knock out, when there's no more natural gas plants to knock out, they're going to be looking for growth. Right? They're trading fuel costs for steel. It's like a classic model that McKinsey developed like a decade ago. When there's no more fuel costs to take out of the system, where does growth come from? It has to come from demand for electricity. And that's why the EV model will be very helpful in aligning all these firms for growth again. Electric vehicles, electrification of everything will drive demand for more wind, solar, batteries. All these utilities are making more money despite the product being consumed less. One of these days, like that act runs out.
So your hypothesis is that they need to go from owning the supply to owning the demand.
Correct. Well said. Yep. They need to be more involved with owning the demand.
That's Ben Thompson's aggregation theory in a nutshell, right there, coming to energy.
Is it?
Yeah.
I get it daily. Admittedly, get overwhelmed. Wait,
Too many newsletters.
So explain. Hold on. Then I feel like, because I probably butchered it, explain to me in your words what I said.
That's a nutshell of how we worked at Choose.
Yeah. If you said exactly what I said, how would you have said it? I think it's a question of where the value is most realized in the value chain. Is it realized in the supply? Is it realized in the distribution, or is it realized in the demand? And historically, a lot of business models have worked where the best way to vertically integrate, if you could take two of the segments, is you wanted the suppliers and you wanted to own the distribution. And digital technologies, the argument that Stratechery makes is that digital technologies have actually flipped that. And so the best way to vertically integrate is you actually want to own the customers, and the suppliers just make themselves commoditized. Because you own this huge aggregate of customers. And so I think kind of what you're describing is the same thing is playing out in this space, whereas now it's important to actually own and control the demand, and then that lets you do all kinds of interesting things on the supply side.
Man, that is it.
I mean, we've seen it play out in tech, right?
Energy transition solved.
Networks get valued more than assets.
Good. Yeah. So, but then no utility for now until they see an end in sight for their ability to flip fuels for steel. Will be forward enough thinking to want to go get the demand. That's why I think Tesla has to go in and acquire, and probably not NextEra because they're the most expensive. But if I were them, I would go find a utility in a pretty cool region of the U.S. that has some EV adoption and buy them.
Why not PG&E?
Just a clusterfuck.
You get it for a good price.
Or maybe like, one of the municipalities, like Sonoma Clean Power, like all these other ones that are subsidiaries, and just say we're gonna give every single person in this area a Tesla. Right? Let's just go as extreme as you can get. You get a Tesla for $300 a month. You get a Tesla in your energy bill.
Oprah of energy. You get a Tesla, and you get a Tesla.
You get a Tesla. You get a Tesla.
Could the infrastructure? I guess if you're doing a small enough utility, your infrastructure could probably support that. That's the other one.
Depends on the age and a bunch of other factors.
That's what makes California tough. Probably is the fact that the peaker plants and all that good stuff are not quite there.
Let's dovetail this into the California discussion, though. Kind of big announcement from the governor this week. Thoughts?
I mean, you guys are looking at the EV charger market as well. I want to hear what you think.
That's your cue, Jonathan.
That's my cue. I don't think it's going to happen.
Ooh.
So, I mean, like, I don't think that for those markets it's technically feasible in the time frame that's been discussed, or you'll end up with all kinds of crazy market manipulations where, so for instance, in Texas and another market, I'm going to use an analogy that I think is going to seem pretty strange here. In Texas and some other markets, the building code requires fairly low gallon per flush toilets in new construction.
Right.
A lot of people get around that because they keep if they're renovating a home or they tear something down, they actually keep the old toilets. They get their certificate of occupancy. They go out of state. They buy toilets and bring the higher gallon per flush toilets back because they're worried that their low gallon per flush won't work. Whatever the case may be, right? I think the same thing could end up true here. Is that even if you could enact this law, people are going to go over state lines. They're going to register their cars in other states. And then just broadly, okay, so last PG&E rate case is 20 through 2022. CAISO, you're talking about 3-year rate cases. They're basically locked in until 2022. They've had a hard enough time getting the infrastructure spend to accommodate what they already have. You've basically got 2 of those rate cases left. Like, what are the chances that Northern California in particular completely fixes its infrastructure problem and then installs all the new infrastructure that's necessary to accommodate basically changing peak demand hours? And okay, they're decommissioning Diablo Canyon. Those peaker plants they're importing power as it is. I know Kevin has written a lot about that. I mean, like, I want to believe, and sometimes technological progress happens a lot faster than we think it will, but I don't buy. I think it speeds up trajectory, but I don't think it happens the way that he described in the timeline he described.
What do you think, Kevin?
I agree. I actually think the bigger news that was kind of ignored here was China.
Oh, yeah.
China's announcements around what they plan to do with EVs and decarbonization over the next, 30, 40 years at this point. But one, they're unilateral. They can make it happen. And number 2, none of these things matter unless China's involved. As big as California is, if we want to decarbonize transportation, it has to come from China and India. So to kind of cop out on the question, it's China's news is bigger and they can actually do it.
Yeah. California can't move the whole market by itself. I don't think.
Is there one state that you said they're going to do it? you would believe?
The one we live in, Texas.
Because of the market structure and smart meters?
Yeah, I think a few things. We've built the transmission and the infrastructure to handle it. We have smart meters that can reward customers for it. You're one plug away from being a backup generator to the home.
Yep.
Now that would take an innovation. That would take somebody building a two-way smart plug, and don't get me wrong, that's very difficult. But the market structure would reward the EV owner here. And Texas has historically been good at just enough regulation to make sure that it happens, and incentivizing private companies to make it happen. So yeah, I think Texas would be the market that if they did it, I think it would happen.
What about the people with the love for their Ford F-150s?
I think it's the same problem that Jonathan just described, that if you banned those, they would go to Oklahoma and buy them. I don't think that's unique to any state. But I think the incentives here would make sense. I just think this happens over time, as you don't have to trade performance for electrification. Like, I don't know that it's something you can necessarily legislate fully.
Yeah, we're going to get this massive increase in model diversity that's available over the next 5 years. It's 350 new EV models slated by 2025. Even if they get half of that, a large number of those are trucks. They're other types of vehicles. I think that on the zooming in a little bit down to the company level on the EV charging side, what it says is you really need to be thinking about smart load management for your site host customers. That's the big takeaway here, is that if this happens, whether it's just an increase in the number of EVs on the road, or whether it's outright all new vehicle stock that comes into a state ends up being EVs, your site hosts are going to really care about this. Everybody's going to end up pushing more capacity charges towards those commercial customers. That's going to matter an exponentially, I think, increasing amount.
I agree. I think that there'll be a lot more awareness, like your internet connection at your house. I think if you ask the average person, do I have a fast or slow internet? They know it painfully well. Nobody really knows about their EV load management structure at their home. They will know very soon.
Yeah. Something we talked about today too that I think will remain true is, regardless of how range changes with EVs in terms of how far a battery can go, people will charge every night.
Right. Yeah. Actually, though, let me tell you something. So I have, one in the garage, got a level, I don't know, somewhere between a level 2 and a level 3 charger. It's 50 to 60 miles an hour of charge. I don't charge every night.
Really?
And I drive every day.
Interesting.
The data says you're the exception.
No, because the battery pack I think it has 360 miles or something of range on it. It's like a gas tank. Well, I get out, I'll be like, okay, there's 150 miles. And then a few days later, I'm like, all right, I'll plug it in now. It's definitely charged at home. And I've charged it at Volta chargers every now and then at destinations. But it's definitely not an every night thing. Now, I think the cheapest cars will be cars with 60 miles of range, and therefore you'll need to if you're commuting. But I mean, the announcements that they're making now are all these cars are gonna have a couple hundred miles. They might be one of those things where, the utility will be able to incentivize people to charge Friday at 8 p.m. and that's when it's going to happen.
Let me ask you this: how does that behavior compare to how you do battery management on your phone and laptop?
Yeah, and there's a few other things. There's going to be this is a single family home. In apartments, we'll have to be managing all of that. It'll be it'll look more like the washer dryer system at a multi-family unit where people know that Sunday nights at 4 p.m. if you try to go use that washer dryer in a shared building, you're effed. And so I think there'll just be scheduling systems will have to be built. There'll be load management systems for the building tied to that. There's going to be a lot of complexity, but it won't happen as much in the single family home as it will in a multi-tenant location.
Yeah, and it's about a thing that was implied by all this, but not explicit, and I think is worth making explicit, is it's all about matching charging speed to dwell time.
Yeah. there are there's actually some incredible, this reminds me, some incredible private equity owned businesses that own and operate like some ludicrous number of the dry cleaners in the US. And it's good, like the people that own and operate, or at least that operate the Create network, are going to look a lot like that.
Should those be the next entrepreneurs in this space?
It'll be software based. Like they help manage scheduling and billing and parts replacement for all the laundromats. But there'll be something similar, like the electrical equipment. Like Volta charges, their average site charges like 8 to 12 hours a day. In a multi-tenant situation, it'll be the exact same thing. Electrical equipment will blow out a lot faster. Like whether it's the one nearby, whether it's the substation down the road, and there's just going to be a huge industry around predicting when that's going to fail, optimizing parts, having stuff ready, and load management. It's going to be like a big business, and software solutions will be a big part of it.
I think the killer use case for that type of charging is billing and load management. Like, Can you take all of that away from the apartment? They want to be able to offer it as a perk. They want none of the cost of operating it.
It also makes you if you are that business, it makes you the most organic channel for other value-added services around resiliency, batteries. I think it becomes an opportunity in a lot of those tangible spaces.
The issue is going to be that this space will always have a hardware component to it. You'll have to put some hardware in to own the software layer, and a lot of ventures hates that idea.
Yep.
Are they wrong here? I mean, we obviously have an opinion, and I'm pretty sure I know yours, but
the real estate, however you want to define it, but like the idea that this is a physical product that has a physical real estate position in the garage, in front of a store, in a parking lot. Like real estate's really important. So and how do you lay claim to real estate? There's something physical you're doing to connect to the local network.
Yep. Do y'all have time to hang around? Do you want to talk SPACs? So, John, the other news you broke this week on the edge of, I guess, on the heels of ChargePoint's SPAC, which, by the way, you called the valuation. I think you said last week 2.25.
2.25. 2.4 was the number. It traded up to 2.6, 2.7 today.
Yeah. Not
bad. Call it Switchback Energy. It's now Switchback Energy.
Which wasn't Switchback, or I guess it comes off. It's all oil and gas owned.
Yeah, it's NGP. Yeah. Natural Gas Partners. Literally
friends down the road.
Yeah, they're in Dallas, right?
Yeah.
Yep.
We met with them recently.
They have another one. They have another SPAC they launched also with a sustainability angle. So that's the topic. There were 4 SPACs in market in August with an ESG focus. There are 14 as of like tomorrow. And then there's going to be 65 by the end of the year. That's a lot. If the average one has $300 million, okay, that's $18 billion, which may be more capital that has gone into anything digital and energy in the last like 10 years combined.
Yeah, that's got to be pretty close.
I mean, so that means they're going to be investing in like, I don't even know what. Like, honestly, I don't know what.
Yeah. Are there that many high quality businesses that are targets for this?
How many companies do you have in your portfolio?
I'm not sure any of them are ready for a SPAC yet, but call me again next year.
Yeah.
Well, if they are, we'll listen. No, that's
yeah. If you're a SPAC sponsor and you'd like to speak to any of our portfolio companies, please reach out to.
Yeah, we'll make it happen.
Yeah, I've spent more time on phone calls with bankers from the top banks on this topic in the last week than my entire career before. And first of all, the incentives for the people playing in the system, whether it's the SPAC sponsor, the SPAC shareholders, the pipe, ultimately the company, are all real weird. It's non-standard. And it's actually what people don't get is it's really just a super expensive or a potentially super expensive cost of capital to be quickly into the public markets to gain access to a huge balance sheet. And so if you're ChargePoint, what was really lucrative about it was you've been in the private markets since 2009. You'd raised $700 million of private capital, and your existing shareholders are tapped out. So you need to find new shareholders as soon as possible. And this gave them a mechanism to go to the public markets. The problem is that pretty soon the public markets, I'm guessing, is after 1 or 2 quarters of performance. I think ChargePoint will hit their numbers, but of a few of these firms not hitting their numbers, and it's going to become really, really expensive capital. Like right now, it's 20% cost of capital. It's going to turn into like 40% cost of capital to go public through a SPAC. And so therefore, only the worst companies will go public through a SPAC, and it'll be a signal.
So you don't think the competition in the SPAC landscape will drive that cost the other way? You don't think that having 65 SPACs chasing ESG companies, you don't see that driving down where the current market is in terms of cost of capital to do this?
I think it depends on how these first cohort of companies perform. If they perform okay, then it'll be great. But what people don't get is the SPAC doesn't set the price. Okay, here's like 3 points of today. SPAC, you see something out there, the SPAC does not set the price. The pipe sets the price. What happens is if you go do a SPAC for $300 million at a $5 billion valuation, the public shareholders in that SPAC right now can say, that's a stupid fucking price. I'm not paying it. And they have up until 2 days before the IPO, the ability to redeem their shares and retrench. And in that case, the pipe has to backstop everybody who leaves. And so really, again, it's the pipe who says, I'll backstop because I believe in this price. And so they will actually be the ones saying, I'll backstop at 2 billion, not 5 billion, you idiots. And so pretty much the SPACs are all kind of waiting around until a pipe says, we'll be the accordion supporting this at a $2 billion valuation. And then miraculously, the SPAC will say, 2 billion, that's the price. And so it's the private market investor who usually is also an existing shareholder who ends up doing a little more influence on the price because it has to be realistic.
How does I've read very slightly on this. How does the warrant situation play into this? Because I know that's also part of it, is how many warrants you can claim at the very edge of the market.
Yeah. So the big key here is you have to, they all ask for like, I don't know, what equates to like 15 to 20 million bucks of value, which is, it depends on the company. And that's where the more competitive process will narrow them down. You know, there was whispers that at one point ChargePoint had like 12 or 13 different SPACs pitching them. So they were able to negotiate like way down. And that's where private markets will help with the best companies. And just to be clear, like ChargePoint is a great company. If you believe in electrification, they have the biggest network in the US. They may have bad financials right now, but if you're betting that in like the next 50 years, electrification is the thing, which you should be, then ChargePoint's probably a thing. Right? And maybe they get bought by Shell, who decides to wake up and get their head of their ass. But that is like there are some great companies who should be public, and I think this will be a good mechanism. And they'll use their negotiating power to lower their cost of capital.
Yeah,
It sounds so simple when you say it.
It has to be a bubble. I mean, but you mentioned this too. It's not just I think from our perspective, we often just think about tech, but I kind of asked you on Twitter the same question Jonathan did, which was, are there enough companies to make this happen? And you said there are a lot of services companies in this space that you think are probably
right
SPAC worthy in terms of getting into the public market.
Right. So when a SPAC goes public, the sponsor essentially pays somewhere between like $5 and $15 million of fees. And so at the end of their 2-year mark, they are very incented to find any business or they have to pay back that money. And I think what we're going to find is in 24 months, there's going to be a lot of really interesting businesses classified as ESG.
Yeah.
You know what I mean? Right? It's just the fact. And the marketing and messaging and metrics will be created where a lot of companies will be classifying themselves, which as of today are not ESG focused.
metrics like positive cash outflow.
That was a good one. That was a good one. Yeah. Just like, I don't know. Like I could see like, green hotels being classified all of a sudden, and just like people need places to park money.
Yeah. Specifically oil and gas focused people need places to park money.
So actually I have a question to throw back to you guys, which is you're in Dallas, which is, obviously in the heart of the original Texas and oil boom and energy boom. You're close enough to Austin and Houston. You have friends in those markets. There seems to be incredible skepticism about the newest wave of companies. Do you think it's jealousy? Do you think it's founded? What's going on?
Yeah, so there's two camps. I think there's a camp that knows this is coming, but pushes back when the majors make an announcement as like they're stupid and they should still be focusing. Like there's a camp that knows it's coming, but human nature doesn't allow them to understand how fast it's coming, if that makes sense. It's like I see a lot of skepticism on like BP's announcement, and maybe they are or are not picking the right strategy, and we've debated that, right? But the fact of the matter is they are trying to do something that is not core to their business. And as someone who is close to oil and gas, if you are, that should scare the hell out of you. It's not the strategy that they're taking. Like we can debate like are wind turbines the right thing all day, but the fact that they're looking at oil and gas and saying, oh shit, like that as a person who works in oil and gas should scare you. The Dallas Fed came out yesterday and said essentially like, if you're in oil and gas, you should get out. They surveyed oil and gas CEOs. 66% of them said we've peaked. And I saw somebody in the oil and gas industry on Twitter, speaking of like people we know in Houston and Austin, Dallas, retweet that and say that the 34% who said that oil and gas hasn't peaked should be fired.
Yeah.
So I think it's also generational. I think people our age understand that they can't be in oil and gas forever. And so they see it. There are some our age that think it's too soon and too fast. And then there are still people that just think that it's a cycle and this is 1987 all over again and things will come back. The price will come back, but the price will come back because there will only be 5 oil and gas companies left in the world.
Yeah. Well, those people are, to steal this from Taleb, like those people are the Thanksgiving turkey, right? Like the farmer is your best friend. He's fattening you up. And it's like, it's happened every time so far. Oil and gas has always come back. This time will be like the last cycle. And that's always true 100% of the time until it isn't.
Yeah. What was that bumper sticker they have around Houston? Dear God, give me one more oil boom or something. I won't waste it.
Yeah. It just like, this is not cyclical. It's just not.
Yeah. It's over. Yeah.
It's just a question of how long it takes for that value to degrade.
Yeah. Some things have changed. I mean, like we're out talking about the firm and what we do. And we used to be really cautious about sharing the climate change. We didn't want to be ESG, and we still don't want to be ESG. We want to be, value driven, value creates value, kind of that mentality. Now we have to be careful not to talk about oil and gas. Like when we say we invest in energy technology, people don't want to hear oil and gas. We have to preface that this is not oil and gas.
But do you still have friends in Dallas who don't like, or your Houston folk? There's some folks who just they have nailed their flag to the oil and gas story.
Yeah, absolutely.
Yeah, there are some people who don't like that message, but there's a lot of value created by committing to something slightly before the consensus realizes it's a good idea.
I mean,
like if no one else ever agrees, it doesn't matter. Right. You want to know what everybody else is going to know a little bit sooner.
Well, and one of the tweets I tweeted that got, I don't know why I got pub, but it was like, I said that the oil and gas industry is interesting and that everybody who's a contrarian has to be anonymous on social media. And I got a lot of comments on that. And I don't have a horse in this game, but I just, it's interesting. And some people were saying this is the only way we can keep our job.
Yeah.
And what does that tell you?
I mean, It's very personal. Yeah. And so you can't have a contrarian view. And it's going to hurt them, man. It's just going to hurt them. Like, I have a buddy that works for Howard Hughes, and they are really worried about the Woodlands. They own most of the Woodlands, and they are very worried.
What's the most important follow? Oh, sorry. I was say, what's the most important follow-on effect of this that no one's talking about? I don't have a good answer there, but real estate prices in certain regions are obviously going to be affected. Like, I shudder to think what Midland would look like in 20 years, but like, what is no one talking about yet?
Oh, I mean, it's really easy to say, look at Detroit. And I feel like that is like probably the right answer. But like, I still, like, I really do believe this. We have a guy named Mark on our team we recently hired who came from Exxon. Where, like, they still are the best engineering companies in the world. Exxon, BP, Shell, like, what they do to extract something from, like, the core of the earth in the middle of the ocean is incredibly complex. And like, in the process they've done it to do it, I know there's bad stuff in the news, but most of the time it works stunningly well. And so, like, short of some mentality, like, it's just repurposing that talent for something else would still enable them to compete. Like, in oil and gas extraction, in Detroit, they were competing versus, like, the Japanese vehicles coming to market. Like, in the U.S. energy policy, there's no other part of it. Like, there's no third country they're competing with. It's just other people. It's wind farms in Arizona. So just repurpose that talent for other really important engineering feats. Like, they'll get paid for carbon extraction. They'll get paid if they found a way to do it and prove they could do it at scale, they'll get paid. But if you look at the public markets short term, they've crushed BP recently. Yeah. Like, the last week, they've just gotten hammered. I think their price hit an all-time or 25-year low recently. Yeah, exactly. I mean, if they can figure it out, right? I mean, then you should buy it. But there is a lot of engineering talent. But is the engineering talent too specialized? Is the mentality right to do it? Will the public markets give? This is the, like, you read The Outsiders, you read Lessons from Titans. You have to have patient capital. I got to go in like a minute, but if I were a mid to senior level engineer, I would find a super smart business lead in the organization and say, let's go put together a business plan on carbon extraction using 100 engineers from BP, 200, whatever, some ludicrous number to the outside market, but would be a fraction within BP. Make a business plan and say, we'll get it 50% funded externally and 50% by BP, and then give them like 3 years. And I bet you they will do something crazy. You do what the CEO of Roper did in a way where, like, now they're a software driven business, right? But, like, if you're a, kind of our age, mid-level, leadership person or a little bit older, go try to be an executive at a mid-cap oil and gas firm that has shareholders that will let you go work on something extreme. It's if you hit it, you're going to be massive. And if we don't, we're screwed. But hey, we were probably screwed anyway because we were going to sell our assets to ExxonMobil, Shell, or Chevron. Yeah. Yeah. I know a few PE firms. Maybe that's what we should do. Just put some job postings out to say we're hiring 200 engineers in the Houston area for a special project. Yeah.
That's why Greentown Labs launched there.
That happened this week, right? Or was that last week?
This week. They announced their location this week.
Yeah.
Yeah. With sponsorships from oil and gas companies.
Yeah. But it's the right talent base. You're right. I mean, you look at, Kevin and I are big fans of that book, 7 Powers by Hamilton Helmer, and the iconic example of, strategically, like, the reason Kodak failed is because one of the many reasons that Kodak failed to capitalize on the digital camera revolution is, like, even if they had gone after it, they didn't have any of the core internal capabilities that would have made them a great digital camera company. But that's not the case here. There actually is a lot of the core engineering and logistical expertise, and frankly, public markets expertise, financial capital expertise in these businesses that can make them successful contributors to the energy transition. They have the skills, they're just being deployed against something else today. But there's no reason that with really excellent senior leadership, that can't change.
But if you had a big pocketbook and you were in the private markets and you did that model, you could go buy companies working on this. So you could both have engineering talent that knows how to scale and deploy solutions, and you could go buy technology probably for cheaper than it's worth now. You could probably get it at a good price for what it could be worth in the future.
So do the barbell effect. Go buy a bunch of assets on the growth side,
That's right.
solar, wind, and then go do something on the other side, which is a complete long shot, where you own 80%, have 200 engineers working on something important.
That's it.
Maybe an idea.
I mean, it's traditionally worked in industrials, but anyways, well, cool.
I gotta jump. It's time.
Quick, impromptu episode of Power Down. See you, everyone.
See ya.
Happy Friday.
Loved it, guys.